Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Adam Webb. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, FTSE Russell, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Today I spoke with the CEO of Macrohedged, Adam Webb. Adam tells us how he got into trading, why he chooses to trade options in the energy markets, insight on how his options models work, automation of options trading, the importance of Skew, and last but not least, we discussed how he uses futures in his options strategies, and he gives futures traders a basic example of how they can use call spreads or put spreads to directionally trade their market. So without further ado, let me take you right to the interview with Adam. Adam, how'd you get involved in trading energy options?
Well, I got involved in 2006, and after I left Goldman's, I was actually doing exotic options, OTC exotic options for yen, and completely left. And it was really through the basis of not being able to get a big prime to be able to independently market make something like FX yen options at the time. And I kind of looked through. The CME had, that NYMEX at the time, before the Merc bought them, had great volume going through. There was lots of volatility, and it just, all the models that I built and took with me were fitted really, really well. So it's I kind of fell into it for the first couple of years, and it wasn't really until I started to kind of build up some method that I overlaid that and really expanded into the energy side.
Because you trade options, I'm curious, did you start with stocks, futures? How did you eventually get your way to options?
Yeah. So when I first started trading, it was futures on the life floor in London back in the mid to late 90s. And at that time, the life floor had just taken, I think they took the London options market as well, which they kind of merged together in the mid 90s. And always the CME, NYMEX were just, 100 times bigger. And options were just kind of dangled on the side really back in London. There wasn't much going on. And slowly as the late 90s came in, the volume came about, but I was always futures in the pit. And just didn't find it as comfortable as when I look back and think, I like more time. Whereas the futures guys have, really kind of back in the day were kind of in and out and market making at a rapid pace. There was a bit more thought going on with the options side. So when I moved upstairs, as we called it, or back to the trading room, I was more focused on the options, and we were also focused on. Then we came off exchange. So we were doing OTC currency options. They were all exotics, kind of at that period of time. A knock-in and a knockout and a barrier option were things that were really kind of new and innovative. And I kind of came into it then. And then after leaving Goldman's, I then went back to on exchange. I guess you kind of go to the thing you first did. And that's how I find the energy options space, because I got the structure of an exchange behind me, so I didn't have to worry about a big prime, but I could also leverage the options space.
Why energy options? Why not E-mini S&P options or other options on other markets?
At the time, And even it's actually still true today, right? So you look at kind of some of the things like the currency options on the Merc, and they don't have a huge amount of volume. There's always prices, but there's not a huge amount of volume. There's a huge amount of volume in the Mini, but then the spreads are tiny. There's not much to make there. There's not much Theo to take out of that. Energy's just fitted perfectly. There's enough volume going through the pit at the time. There's been enough volume always going through Globex. If you ever kind of look at the volume on the energy side going through Globex, it's phenomenal. Considering the Merck's just got that front contract, that CL contract, and they're sharing the other side of the pie with ICE there. There's a huge amount that goes through. So I looked at that, and also volatility. You kind of you want something, when you're looking at selling Vega the whole time, you want something where that Vega is going to move for you. FX was always, you'd have to wrap it up as an exotic to start to get some kind of punchy Vega in it. Whereas there it sat straight away with crude. It was fantastic. So it was perfect for me because the market was very well saturated with all the equity guys that they had that sewn up. There was just this little gap, and it was perfect.
Yeah, it's interesting to me as someone who's not an options trader. I trade futures. We choose a market that really fits our personality. Like I trade the S&P. I really don't trade the NASDAQ. I trade the 10-year Ultra. I don't trade the 30-year. I trade markets that I like the way that they move. They set up well with my strategy. And to me, listening to you as an options trader, it's more about liquidity. Am I right on that?
Yeah. It's about kind of what you can, how much edge you can take, and if you all the time we're looking at. Let's take something really simple like a 60 call in the crude. If that's trading in the December, if that's trading at 60 ticks at 63 ticks, it's a 3 tick wide option. My Theo might be 61.28. So if people are paying me at 63, even 62, I've got 1.48, 1.58 free ticks that I've built into my Theo, where that still exists. The crude market, it still allows you to kind of exist onto those Theos. Whereas that you look at things like the equity stuff. There's so many what I call join or me too guys, where it becomes a bit more like a futures contract. I know guys that are quoting options that don't even have a model. They're just if it's 2021 and there's 10,000 on the bid, they'll just join it, and they just want to be part of that. And that's great for people trading, but for me, I look at it as how much theoretical value can I extract via edge. That's all I really care about.
So it sounds to me as though the energy markets have a lot more action, we'll call it, in the options market than a lot of the other markets, and that's a big reason why you're choosing to trade them.
Yeah, it's very active, and it's also been something that the CME, after their acquisition, has managed to make very Globex rich. What I mean by that is it's not just a lot of prices on there. Some products have just a lot of prices, and they're tight prices, but nothing's really trading. There's a lot going through. You can click on any of the crude contracts, even kind of November contracts, or even out to kind of next February or something. There's thousands gone through at every single strike, on both on the puts and the calls, and they've created a lot of activity, which creates a lot of gamma hedging, which is kind of self-fulfilling. It's building a bigger and bigger market. And one of the things I really like is we're still commanded by a physical entity. It expires into a physical contract, and there are people that actually require that. If there's some guys that have got too much to go on a Friday afternoon in Texas, they'll just dump volatility and do not care what price it gets hit at. Those levels of kind of excitement were only really seen, maybe you could argue 2008, late 90s, but it still kind of happens in a mini way every Friday because someone's got actual physical business to do, and that's what I love about it.
Yeah, it's interesting. I want to talk about models. You mentioned that you took the models that you built and then you went to start trading energy options. Talk to us about your strategy for trading energy options.
So predominantly for me, I'm looking at an edge around a price. So there is most of the kind of primary models that are out there, most people have got. And what you're looking at is at any point in time, if we don't try and take a view so much, is at any point in time, if the price is 5 or 6 ticks wide, you want to make sure that your futures hedger is going to be able to get the contracts off when you get hit. You need to make sure that if there's some activity coming in, that you can participate in that, because the last thing you want is to not be able to participate in what's going on. So I kind of run some different models. One is I have a futures hedger that runs on a micro pricing model. So it takes an accumulation of the 10 deep of the ladder. I actually only use 4. And then, so whereas, futures might be 2021 or 23, 24 at the moment, but my price might say it's 23.43. So I know you can't trade the 0.43, but I'll do more on the offer than I would on the bid, because my micro pricer is saying to me that the actual true value is actually below 23.5. So if it comes down to say 23.1, I'll probably only be able to clear on my hedge side at 22. So I won't even show a 23 bid. So I might go 22, 24. That's what I'm sending back to my hedger. So that's one hedging side. So every time someone clips, you hedge straight away. So that's primary model number one. Secondly is the price itself and how you're calculating what you deem volatility to be at the moment. So that can be, you've got to make sure you pull out all of your calendar dates, any US holidays, any non-settlement days that the Merck's got. That model is where the core Black-Scholes is sitting in there, and then we've got adaptations of that as well, which gives a theoretical value. So at any one time, I will say that we talk about skew now, but my skew path might be uplifted kind of 0.1, 0.3 ticks as the strikes are going out. A volatility, I might say, is a nice round 20%, and I can portray what all those values will be out right across the skew, right across all the vol paths. And then anything that's miles out, everything kind of feeds back and says you'll get clipped if you do all of these. Then we know we've got a problem. So it's hugely automated.
You mentioned Skew, and I've heard you talk a lot about Skew before. Explain to everybody what Skew is. So
the easiest way of explaining it via a radio without physically seeing it is if you've got price along the x-axis, and that let's use crude for as an example. So we've got kind of $20, $30, $40, $50 of crude, and price along the x-axis, and volatility is along the y-axis. When the first kind of models were coming out in the 70s, when Merton and were releasing them, they worked out that the volatility of an option was constant. So no matter what the price, no matter what the delta was, that volatility was constant. So if you were looking at, if you wanted a $20 put for crude oil for next September, and let's say the volatility is 20%, it would just be 20%, whether it's a $20 or $30 or $40, it will just be constant. So, but this clearly doesn't compensate the buyer or the seller, and B clearly can't be right, because if crude collapsed from $56 down to $20, I can promise you volatility wouldn't be 20%. So Skew kind of came about by people wanting to be compensated for change in price. So it's kind of like if you imagine you've got a mattress, and when the first models would come out, this mattress was like perfectly flat. It was one of those memory foam mattresses. And as time went on, somebody got a huge bowling ball, but it wasn't like a 16-pound one. It was like a 200-pound bowling ball, and they just dropped it on that bed. It would leave a big imprint. And you look at what the at the money is. So like, let's say for crude, that $56 right now is the at the money. That would be the lowest point where that ball makes a dent in the bed. And then if you can imagine, if that was froze that in time, and you put your hands into that gap that it is, that dent it had created, and you slid out, you'd see your hands going up like they're going up the side of a dessert bowl. That's skew. Basically, people are lifting what's known as lifting the wings of an option for a higher volatility to be compensated. So right now, if we use we use the S&P as an example because it's a good one to use. Is, you know, if the S&P went down to 2,400, it can promise you that volatility wouldn't be 14%. I mean, you know that, Anthony, it would be more like 35% if we went down there. But if you look at the skew right now, someone's saying, well, look, I want to be compensated for that run down there. And December S&P 500s is actually already 24% there. So the guy's halfway compensated it. And he's okay to manage the variance of the sell-off. So skew is kind of saying, well, if this did all kind of fall flat on its face, I need some compensation for it. So skews come about by bending those models to represent that risk on, risk off model. So an equity skew looks like a tiny Nike swoosh, where all of the scare factors in the put side, it looks like the Nike swoosh going up, and the call side is just suppressed this tiny little divot. They call it a smirk rather than a smile. And then you look at something like corn, it's like totally the opposite. The calls are always lifted and the puts suppressed. Gold's the same; it's the polar opposite of the mini. Crude's always put side risk. So it looks a little bit more like an S&P 500 skew, but it's got more of an upside call side as well, because if there's any political pressures, everyone wants the calls. So I hope that kind of puts a vision in people's minds of what skew's really doing, because no one will just say, hey, you know, the kind of black swan event is someone going, look, it's, you know, a $20 crude for 20%, you'd be buying them all. You'd be buying them till forever, because they'll eventually pay off 10,000-fold what you've paid. So people want compensation for that. So a $20 crude is actually already like 40%.
Hey everybody, I want to take a moment to thank one of our sponsors, FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-mini Russell 2000 Index Futures, contract symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. I want to talk about the execution of these models. You said a lot of it was automated. Are you point and clicking as well, or is everything automated? How does all of that work?
So most of it's automated. So we kind of split it. So most people are mass quoting. So that means it's kind of a cool feature. So rather than you can kind of Google this from the Merc. It's everyone should know this. There's an order that goes into the Merc for the futures. There's an order you can put in for options, but there's also something called a mass quote. It means it's something you can change on a much more frequent basis that doesn't provide so much overhead into the Merc. And so most people are mass quoting their options into that, and that's automated. So I could just say, right, if my model is saying something's worth $60 or 60 ticks, and I want one tick aside, it will just quote 59.61. So if someone wants a $60 call and it's 60 ticks, I'll be quoting 59.61. And if the underlying ticks up 5 ticks, it will just follow it. So it's always quoting that price and following it. And that's why you'll see, if you ever watch a kind of an at the money options ladder, let's say if you wanted to look at those 56 strikes in crude now, they'd be flickering around all over the place, because that's what those guys are all doing. They're quoting around their Theo. So that's fully automated. If somebody it's really important to note that most volume going through is not people just buying calls and puts, right? There's very rare. It's so rare that you might get the odd line of 5-10 lots or something goes through. But most people, like if you came to me and said, I think the back end of the year, we're gonna sell off, but I think in the run up to the next election, I think we're gonna see crude come back up, right? That could be your view. You would come and say, I want to put this strategy on. So 90% of all the flow going through is strategies. So you might say, I want to sell some $60 puts, some $60 calls December, and I want to buy some December 20s for $60 as well. What's the variance? So it's a limited risk strategy for you, but that's what most people are doing. And that goes through the RFQ, the request for quote model, which the Merc operates. And that's most stuff's going through there. So people build strategies. You can do some absolutely kind of insane stuff and just hit request for quote. That comes through, and they're auto quoted. So a lot of guys will protect themselves. They won't do things like anything above like a 1x5, because you're just kind of, have someone doing a 1x20 and you get tricked into doing something. But most people will quote those. That's the all fully automated side. You've then got the block side and the OTC side, which all clears through Clearport, and then you've got the brokers sort of scattered all around the major cities, and they've got kind of the bigger funds that are asking for, how do we price this, or what can you show us on this, and they'll build prices just like, think back to the kind of the big stuff going through the pit. You'd have to line up a few of the locals to take it on, and that's what these guys are doing. Those brokers are out there lining it all up, and it all clears through Clearport. That's cabin doors to manual.
Yeah, what I want to try and understand is just how you go in on a daily basis and look at these models, these strategies that you built. Are they running 24/7?
20. Well, I don't quote all 23 hours a day, because you can't get out of stuff. So it kind of, for me, it's about 7:00 in the morning London time, and then right the way through to close, so 10 p.m. my time. So that works. That's like 1 a.m. for you guys through to the close.
Okay, and then are you choosing different strategies to run based upon conditions? So you wake up and say, hey, you know what, this is what we want to run today.
Yeah.
And if you are, so you say yes. Okay, so how are you determining that? What is determining, your reasoning for running that specific model or strategy that day?
So the kind of the flip side is then we start to look at how bent the skew might be in proportion to how it's been in the last 6 months. So we start to look at things like the risk reversal. So a risk reversal would be a 20 delta put against a 20 delta call, and then we chart that, and that might be, to give you an example, if crude ever goes calls bid over, so on a risk reversal, so a call is worth more than a put, so 20 delta call is worth more than a put. It's only ever happened I've been doing this since 2005. I think I've seen it once. I think during the Arab Spring, we did it for about 4 days and then went back. So there, that its value has been completely wrecked at that point. You'd be absolutely wading in. We were moving the models to cover that. So you've got things, Friday tends to be the kind of usual vol crush. So you certainly don't want to be collecting too much. So you have to make manual adjustments each day to the models. But certainly we're looking. We use a tool called Quick Strike, which I know is kind of the Merc use as well. And we're always monitoring and checking what our skews are, what our current volatility levels are, and making sure we're making all the correct adjustments so that we're not picking up. The last thing you want to be doing is getting lifted for a load of Vega when it's low, and given a load of Vega when it's high. We want to be doing the opposite, just the same as a futures trader is doing the same thing.
You mentioned on like a Friday that all of a sudden you could have a lot of order flow coming in, right? You said somebody could just be dumping a bunch.
Yeah.
And I'm curious, how do you manage risk in those types of situations? So let's just say if one side that you're making a market for, just all of a sudden you get hit on a bunch of stuff. How does that all work?
So our risk is Vega risk. So we've got two risks. The first risk is a technical miss, or the second one is a Vega risk. So let's use this example of this person coming in, and he's just going to sell a load of puts, okay? And when he does that, we get given the puts on Globex, and we've got to immediately go and hedge that. So we'll go to the futures market and cover the deltas, so we've got no delta risk. So the first thing that can happen there is the micro pricer misses the hit, and we don't get out of the more. So we might, whilst we're quoting 1.3 ticks of edge, we get missed on the futures side, and that wears out that loss. That's covered that out straight away. So we've kind of any built-in edge is gone. So that could be a technical hit because the micro price are missed. But more importantly, what we're left with is Vega risk. So and a Vega risk creates a gamma risk. So for me, I need to make sure I would always kind of stay within the boundaries of my Vega. So I wouldn't want to be more than kind of $10,000-$20,000 per percent of Vega. So if we're given a load, I'll use other options to get out of that. So you've got so much more along the vol path to use. So if you're giving a load of put wings, you might want to cover some of your upside call Vega. So you can move things around. You've got a lot more options. Whereas in the future side, if you just clipped, you kind of I'm sitting on those now, and the only way out is they come back for you, or you just take the hit. We've got a lot more optionality to manage that. So, but my prime, I've had a technical issue if I've got what I would call a futures risk. My main risk is a Vega risk. So when my clearing merchants on the phone, they're not ringing and saying you've got to cover those futures. They're saying, have you seen your Vega?
Yeah, I get it. Even if you're getting hammered on one side towards the close, the automation within the model is immediately putting hedges out. It's either buying options or selling options, or buying futures or selling futures immediately.
That happens. I mean, someone will hit and the bell will go for the cover before you can even blink. It's all done in Aurora before you even know what it is. The only time you get an alert it will say, I only got 24 futures contracts out. I needed to get 38 out.
Exactly.
And then that's more of a head in hands moment than anything else, because usually you'll find that the futures have moved 10 ticks because that's where you've been dropped. So that's a bigger risk. But whereas I kind of don't mind, if you pick up if someone sells a load of puts, it might suit against something else we want to get going somewhere else.
How frequently are futures used as your hedges?
Oh, well, most of the time. So let's say if somebody's going to, let's say this guy's come in, this imaginary person, he's just sold all these puts and I'm sitting on them. I want to make sure, so I will immediately hit the futures market if it's outside of my variables. So we'll have a variables to say plus or minus 15 contracts in the front months. So at that point in time, if he hits for 100 and they're all 50 deltas, plus we're already long 10, we'll just immediately hit the future. The key objective here is to neutralize the delta. That's where your immediate pain comes from. So that is job number one. So the hedger immediately will hit the futures market. That's why you see sometimes the futures guys are always the guys quoting pure futures only market making are looking to collect the option market maker's business, because there's an interesting statistic is that I think about, well, certainly on our hedger, 95% of every trade the hedger does is hitting a market order. Whereas the futures market maker, sitting in the Merc, he's looking all day long for the limit orders to be filled. So quite often the options guys are smacking his orders all day long, because I'm okay if it's 21.22 in the market, my micro price is saying it's 21 and a half. Someone hits me for puts, I'll just hit the futures market, no problem at all, with a market order. I don't care. It's that futures guy's problem then. I don't care about that. I want to neutralize the deltas. So the risk I'm in the market to manage is volatility. So I want to neutralize out all the deltas straight away, and then just go, right, I've got 5,000 Vega lots, $5,000 of Vega per percent. That's what I need to manage now. So okay, then I can kind of think about, I can move the model slightly. So okay, just lean onto the calls, and we'll throw some out there. But my immediate thing to get rid of is dump those deltas. Whatever way you're looking at it, don't be carrying deltas.
A lot of what we discussed today was very high level and not for the beginning options traders. So for the futures traders out there that are interested in learning more about options or potentially even trading options, can you give us a few things that we should maybe pull up on our platform and keep an eye on? And also, because we as futures traders focus a lot on directional moves, can you give us a basic options trade example of how we can maybe trade a direction of the market using options?
So, good question. So, if you once you kind of got yourself set up and you're looking at options, or you've got the capability, just keep things really simple around call spreads and put spreads. And that for me, their strategy is that you come from the futures space, so you're hardwired to be thinking about direction. Okay, so but what a lot of people will do, I'll give you an example of crude, is they would, let's say crude sells off $10 or something crazy, and volatility spikes up through the roof, and then people go, oh, I think it's going to go back up, but I don't want to buy it here because it has to kind of get hosed. I'll buy a call spread. So crude's come off, it's gone through 50, and he buys a 50-55 call spread. And whilst that might cost X, but the moment he buys that 50-55 call spread, he's right. And directionally, crude goes back up. And that's fantastic because you're now getting paid for the long 50. But one of the problems that a lot of people come back and say, oh, I didn't make as much money as I thought, because when crude turns around, volatility will fade away. So at that moment in time when you bought that call spread, you were actually buying volatility at the top, because as you said, same with the S&P, as it falls off, everyone does the same thing. It comes off 100 handles, they all go and buy call spreads. Actually, something that's worth thinking about is if you're confident of the turn coming, i.e. we've bottomed, what you see a lot of institutions do is they sell in put spreads. It's still a limited risk strategy, but you're selling volatility at the high, and every day you're getting paid. And then the turn comes. Let's say you're wrong, the turn doesn't come, it carries on going, and you're still in a limited risk loss. But the turn comes, not only is volatility off, you're getting paid. So you tend to find that the retail guys think all the time of the direction of where they want to go. It's like they're flying an aircraft and they want to know where they want to land. A lot of institutions are quite happy to kind of look out the back window and just make sure there's nothing kind of chasing them. And that's if I was going to give a tip to somebody, that's to think that way around, rather than thinking always in the direction of travel. Think of the opposite direction of travel, but in a limited risk way.
I like that example because I've experienced that firsthand. I remember, several years ago, I was looking into, dipping my toe into options, and I started off with just the basics of, buying calls when I thought the market could go up, buying puts when I thought the market could go down. And I learned that lesson exactly that you mentioned. I remember buying calls in the S&P thinking that, wow, the market just got clipped. I don't want to be long the outright futures here. Let me buy the calls. And I saw the market rally like 10 to 15 handles right away, and my calls were at the same price. And I'm going, wait a minute. This doesn't make sense. I remember talking with my options friends, and exactly what you just said is what they were talking to me about. And I think it's a good lesson. Great stuff. We're not done yet. I have rapid fire questions next if you're ready for those.
I'm ready.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets with TT. They are the world's fastest commercially available futures trading platform. Now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. Try it now free at tryttnow.com. Adam, first question for you. What trader has influenced your life the most and why?
I would say Soros for me. The reason is I kind of arrived in the market mid-90s. He was a kind of a superhero from when he broke the Bank of England and pushed the pound out of the ERM. I've read all of his books, and he's how he accepts a loss and how he manages a loss is an interesting person. I also think how he crushed long-term capital management after they asked him for money was certainly an interesting person.
What was one of the hardest things for you to overcome in trading?
I think the growth of the retail market how that's become a primary factor in everything we do now. That's been a real shock. Over the last 5 to 6 years, there's so much more retail flow than I ever expected. There are now institutions that are warehousing that retail flow themselves and not passing it around. So that's from a purely from a kind of personal mindset. That retail flow has been a real surprise how quick it's grown.
How has your trading process evolved over the years?
Speed. I think certainly not trying to be part of everything. When you're certainly, I'm 42 now. I guess even kind of when you're 30, you kind of want to be part of everything. And then you look back and say, that was really exciting being part of that, but we made no money. So you sit back and be part of what's going to make money and calm time. I guess when you're younger as well, you don't, all these things that older traders talk about, kind of getting in the right mindset, all these kind of things, you just go, what do they know? And now when you kind of hit 40, you think about that stuff a lot more.
What is one attribute that you believe every trader should have?
I think you need to be willing to put in the 12 hours a day and be willing to learn. There's a lot of stagnation, I think, in the markets, where people just kind of, in a way, repeating the same process. And it's an evolving beast, and making sure that you're willing to accept and learn. There is no 1 hour trader.
Favorite book about trading?
Oh, for me, the Bible, which is Option Volatility and Pricing by Sheldon Natenberg. There is, it's a bit dated now, but that guy, I don't think there's an options trader alive that either doesn't have a copy on their desk, in their drawer, by their bed, and yeah, that's for any options trader, that's the Bible. Some people might say Dynamic Hedging by Taleb, but for me, Natenberg's book's country mile ahead.
If you had to pick one profession other than trading, what would you pick?
Oh, farmer.
What's the best piece of advice that you received about trading?
You'll be wrong more times than you're right, and however much capital you think you need, times it by 2.
If you could go back in time and give the younger you a piece of advice, what would you say?
I think if I go back in time, it would be, in 2000, when crude went up to $140, it was just tearing everybody apart. If I could, I knew it. The biggest sell-off was coming, but I just watched that happen in front of me. And I even knew when it kind of $36, $37 when it peaked for the backup to run up to 120. I think what happens is sometimes when you're younger, or you're at the coal face of everything, you kind of miss that bigger picture. And one of the things that I've tried to improve by my mindset is stepping away from that kind of crazy stuff all the time. Even just kind of how much I'm getting alerted for trades that are going on. You don't need to know everything, and so I would tell myself there is more time than you think.
If you had an elevator pitch me your edge, what would you say?
I'd say you'll always make money. You can't fight Skew, because you're representing the right way around the overcrowded trade. And if directionally we're wrong, we don't lose. So for me, everything's in the Skew. The maths is there. And it's proven to me since 1996 when I was first introduced to it by Goldman's. So yeah, that would be my pitch.
Last question for today. Favorite thing to do when you're not trading?
I love cycling, and I'm really into kind of growing vegetables. I'm really into doing that. So we've got fields, and I'm really into that.
Where can people find you on Twitter, and give us a website to check out?
So if you want to see the kind of trades we're selecting, macrohedged.com, and also we're Macrohedged with a D on the end on Twitter as well. So at Macrohedged, but macrohedged.com, you can, yeah.
Adam, thank you so much for coming on Futures Radio Show.
Cheers, Anthony. It's been an absolute pleasure.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.